In this lesson, I'm going to be teaching you guys about ICT order blocks and SMT divergence. There's a huge misconception about what an ICT order block is. A lot of people think that it's always going to be the same. Like if price runs an old high, it is always the last up close candle before a large move down with displacement, or with that same logic. A bullish order block is when price takes out an old low and it is the last down close candle before a large move up with displacement. That is not, in fact, what an ICT order block is. There are other factors which make it a high probability order block. And in this video, I'm going to be explaining that to you guys. So if we take a look at the weekly time frame on the ES1 chart, this is the S&P 500, we do have this old low down here. Now in this case, it is the last down close candle right in here, but that's not always going to be the case. I'll go over what makes it high probability and how you guys can identify these on your own in the future. So below old lows is going to be sell side liquidity. Price takes out an old low. We have this last down close candle in here. Now, it's not the last down close candle alone which makes it a high probability order block. It's the fact that price takes out these sell stops beneath this old low. If we look at this weekly down close candle right here, what follows after that down close candle? Well, we have this fair value gap in here. That is one of the key factors that makes an order block high probability. If there is no fair value gap after the down close candle, there is no order block. And that is quoted from ICT in the 2022 mentorship. So if we zoom in right here on the weekly time frame, we do have a fair value gap. It is a very small one, but nonetheless, it is present in this example. Now, what is a fair value gap in this example? Well, a fair value gap is a 3 candlestick pattern. This is candle number 1, this down close candle. This is candle number 2, and this is candle number 3. When candle number 1, when its upper wick, and candle number 3's lower wick do not overlap, and we just have the body of the candle trade in that area, see how this wick and this lower wick do not overlap? That creates the ICT fair value gap, otherwise known as an imbalance, or when it's a bullish fair value gap, it's called a buy side imbalance, sell side inefficiency. He calls it a BISI fair value gap. Since we took out sell side liquidity and we had this shift up in market structure, and it has the fair value gap after this down close candle, that makes this down close candle that I'm pointing towards right now, it makes it a high probability order block. So what we can do is we can draw out there's a few different points of reference we could draw out on the order block. Since there is a large upper wick on this down close candle right here, what I would do is I would draw out a horizontal line on the open of the order block, and I would also draw out a horizontal line on the upper wick of the order block. Now, if this was just a full body candle like this one or like this one, maybe I would just draw out the open, but since we do have a large upper wick, I would just draw it from there. Now let's make sure that this is clear. This entire down close candle is a bullish order block. And the reason it's a bullish order block is because it took liquidity and it also had that gap. The gap in price, or the imbalance, or the fair value gap, these are all different terms for the same thing. That makes this down close candle high probability. It doesn't always have to take out sell side liquidity, but typically if price is going to reverse and change order flow, you will see that run on sell stops. So you could see that price breaks above the order block. We have the fair value gap, is that very small green shaded area. Price returns back into this down close candle. We marked out the open and the upper wick. Look what happens. Retested as support and then starts to continue higher. Now, where is going to be the target here? Well, when I look at this, I see we have a run on sell stops. We have a shift in market structure to the upside. In that shift in market structure upwards, we do have the fair value gap, which is again that small green shaded area, and we have a change in order flow, right? So this order block right here can act as real support for the marketplace, and since smart money is long and the algorithm is now in a buy program, we can now target buy side liquidity. What is buy side liquidity? Buy side liquidity rests above old highs. So above old highs is where typically, not really typically, it's always going to be above old highs, retail traders are going to have stop losses. So those stop losses are categorized as buy stops. That's why it's called buy side liquidity. So above this high at 41.76, we'll say, and then above this high at 43.27 is going to be buy side liquidity. Because we have all of this in this lower area, meaning it takes out the sell stops, we have the shift in market structure to the upside. This order block right here, and we have that fair value gap, this order block can act as support for the marketplace. We also break above this up close candle. So price retests the high probability order block and starts to spool higher. Now, when we continue higher, right, this is internal liquidity in here, meaning that it's within this range. So if we draw a fib from this swing high down to this swing low, right, this buy side liquidity is within this range. This is a dealing range because price took out buy side here and also took out sell side below here. So I'm thinking that it's likely to trade up to 43.27, right, because that's the external range liquidity. The bulk of the liquidity is going to be above this high up here. So as we're kind of trading in this area, here's another example of a high probability order block. So we have an old low over here. Now this is more pronounced on a lower time frame, but below old lows is sell side liquidity. It takes out the sell stops. We get a market structure shift to the upside. What do we have after this down close candle? Go ahead and pause the video and try and figure out why this down close candle in here is high probability. Now I'm going to continue. Because we do have the fair value gap here. So if we draw out the fair value gap or the imbalance or the gap in price, these are all things that are considered a fair value gap. There's just different terminology if you ever hear it. Because we have this fair value gap, remember, candle number 1 right here and candle number 3, their wicks do not overlap. It makes this specific down close candle a high probability order block. Since we do have kind of a large upper wick on that, I'm going to draw out a horizontal line on the upper wick. And I'm also going to draw out a horizontal line on the open. When price returns into this area, that can act as real support for the marketplace, and then we could start to spool higher. Now, just to show you guys that I'm not just saying this stuff in hindsight, because a lot of people like to teach ICT's concepts, but then they don't do it real time, do it live. So if you take a look at my Twitter, this was something that I did post in my Discord, which you can find first link down below. On June 1st, I did actually cover it a little bit before that, but this is just when I posted it in the chat. I do make videos in my Discord where I covered this earlier than June 1st, I believe. I said ES higher time frame draw on liquidity. That's what HTF stands for, 43.27.5. So we were looking for this high up here, 43.27.5, to get hit. The reason I was looking for that level is, again, that's where the bulk of the liquidity was. We were in a buy program, and price was retesting that high probability order block in there. So I was looking for that level to get delivered. You could see it ended up trading up into that area. So we were looking at this order block in here because it had that gap and it took out liquidity. I was looking at this down close candle as a high probability order block for the market to find support at before continuing towards that target. 43.27.5 was traded to. So I'm not just showing you guys this in hindsight, I'm calling these charts live, right? And I think that that's important. I think if people want to teach these concepts, they need to be exercising them real time, right? So we retest this down close candle, acts as real support. Why is it high probability? It takes out liquidity. We have a shift in market structure to the upside. This down close candle, after taking liquidity, it was followed by a fair value gap. That makes this down close candle high probability. Now, what you can do is you could draw out the sensitive points of the order block, which can be the opening price, the upper wick, right? If there's a large upper wick, I'll do that. These are typically areas which can act as support. What you can also do is draw a fib from swing high of the candle to swing low. We can bring up the 50% retracement, so just go into your fib settings. And if you go to style right here, just select 0.5. If we are going to be bullish, we want to see the bodies of the candles stay above the 0.5 level. So that's what we were talking about in the Discord when I did make this video. And we were expecting for higher prices and looking for it to deliver to that 43.27.5 level. I was saying price needs to stay above the 0.5. Now it could potentially come down and wick it. Yeah, that's possible. I don't want to see a candle closure below that 0.5 fib. That is the MT, or the mean threshold of that order block. If you're looking at a fair value gap and you wanted to measure out the 50% level, you could draw it from the low end to the high end, right? Or from candle number 1's high to candle number 3's low. The 50% level will be called the CE, or the consequent encroachment for that. So that's just a little extra tip right there. Wicks can trade below that 0.5. I want to see the candle body close above it. Wicks do the damage, bodies tell the story. As long as we're above that mean threshold, I'm still thinking we can deliver to this price up here. So what have I taught you so far? A high probability order block in these two examples is when price takes out sell stops, we create a shift in market structure to the upside, and it creates that fair value gap. That makes it high probability. This is your ICT bullish order block. Let's go over some bearish order block examples. In this example, we do take out buy side liquidity above this old high. Why is it buy side liquidity? Because retail has buy stops above here, right? We're getting this sharp movement to the downside. A lot of retail traders are thinking that this is resistance or support, now turn resistance right here. So if people are looking for swing trades, above these highs are where they're going to put their stop losses at. The algorithm knows that above old highs, there's going to be buy stops, and below old lows, there's going to be sell stops. So it's programmed to take out these levels to give smart money the opportunity to sell to those buy stops at a higher price. So smart money sells up here. We get the displacement down. Now here is where it gets a little bit tricky, but just follow along with me. See how we have these consecutive up close candles? And then we get that displacement down. See how we have this big fair value gap right here? That makes this a high probability order block. Now you may be looking at this thinking, okay, well let's draw out the high probability order block all the way up here. Here is where the majority of people on social media get it wrong. The order block is not up there. It's not the last up close candle before the large down move. See how we have these consecutive up close candles in here? We have 1, 2, 3, 4, 5, 6. This is one consecutive order block. So what I'm going to do is I'm going to draw out the open of the first of the consecutive up close candles to the upside that took liquidity in a premium, right? We create the shift in market structure down, has the big fair value gap right here. Right, that's your big sell side imbalance, buy side inefficiency, fair value gap, a SIBI fair value gap. I'm going to draw out the open of the consecutive up close candles. When the algorithm starts to pull back up, it knows that this is an area where smart money can accumulate more short positions at. Also, if we do draw out a little rectangle here, we do have a little breaker block in there. So the last down close candle before price makes that higher high and lower low. We also have the change in order flow. So this is kind of like an inversion order block here. And that's why it doesn't have to pull all the way up to here. It's not the last up close candle. It's the consecutive. So this entire range from this low to this high, or to this high rather, this is one big order block. As long as price is within this area, it's within the bearish high probability order block. So anywhere in here can act as resistance. Now it's not likely to trade all the way up to that high because the order block starts down here, right? And this is a sensitive point of the order block, the opening price. So price retests that as resistance, and then we start to spool lower. Same idea here. We have these consecutive up close candles before the large move down with the fair value gap. This fair value gap makes it high probability. I could see ICT's frustration with all these people on Twitter just saying it's the last up close candle before the displacement move down. That's not what it is. It's not every up close candle before the large move down. Like if you were waiting for that here, you're missing out, right? That's not what the algorithm refers back to. It refers back to the opening price of that consecutive up close candles before it takes out that liquidity, right? Now, why am I not using this opening price down here, you may ask? So why not just use this one if it's just the consecutive up close candles? Well, because we have an up close candle, and then we have a down close candle. Because we have the down close candle here, I'm not drawing the order block from down here. It's either an up close candle before the large move down with the fair value gap after taking liquidity, or consecutive. It's not consecutive up close candles if we draw the order block from down here because we have that down close candle in between. So here starts the consecutive up close candles. That's why I'm drawing it from there. Now here, I would draw it from this opening price like this. That's where the algorithm refers back to. So it pulls back up. We have these two consecutive up close candles, the large move down with the fair value gap, right? That's a SIBI fair value gap. The algorithm refers back to that opening price, retest it as resistance, and then we do continue lower. Now this example, it doesn't have to take liquidity because it already took liquidity over here. So when the algorithm is in a spool to the downside and it's just going to continue to offer lower prices in a sell program, sometimes it doesn't have to take liquidity. And this is an example where it doesn't, right? Because why? Well, because it's in a hurry to take out the engineered liquidity all the way down here. So that is where the sell program can potentially stop at. It's going to continue to be in a sell program until it takes out all of this engineered liquidity all the way down here. And it already took liquidity above here. Smart money has shorted or sold to those buy stops above this high. And then we got the displacement down, right? Had the fair value gap. The algorithm refers back to the opening price of those consecutive up close candles. We're in a sell program until it reaches these lows. So this is just an area of reaccumulation in these consecutive up close candles. It actually does take out buy stops right here. Smart money sells to those buyers at a higher price. We get displacement lower. And then it takes out all the engineered liquidity. And then look where we get the reversal at. I mean, this stuff is not random at all. Now, I know it's hard to believe, but every single little minute price swing in these markets is absolutely algorithmic. I didn't believe it at first either, but after seeing these things repeat and repeat and repeat, you just can't deny it at some point. I mean, look how it perfectly creates these lows clustered together. Retail traders are putting their sell stops beneath this area. The algorithm targets those sell stops so smart money can buy at a lower price. They're buying from sellers at a lower price. This is all accumulation. And now we see distribution of the upside because they're distributing their long positions to buy side liquidity or buy stops so smart money can sell to buyers at a higher price. So we're going to be taking a look at another example, and we're going to be taking a look at the lower time frame to show you guys that this is absolutely fractal and algorithmic. Now, what I like to do in my own trading ICT's concepts, I like to trade with the institutional order flow of the market. Meaning, if institutional order flow is bullish, it means down close candles are acting as support. It's going below sell stops for smart money to buy from sellers at a lower price to continue higher. Bullish PD arrays are being respected, right? It's retesting fair value gaps as support and continuing higher. I want to be trading with the order flow of the market. If I'm not trading with the order flow, well, that means I'm trading against smart money essentially. So a lot of people, they look for these concepts and will be in a buy program, the algorithm spooling higher, and they'll be looking for sell setups. They'll be looking for the 2022 bearish model as we're in a buy program, or you could say order flow is bullish on the higher time frames. I don't want to be doing that. I want to be trading with the order flow. So since order flow is bullish on the 1 hour time frame and even higher time frames, I'm going into the marketplace with the idea that I want to be hunting a bullish setup. Now here we do have a bullish order block, and it is high probability, and we'll be going over exactly why that is. We take out sell stops. That's the first key. So sell stops have been purged. When price takes out this old low right here, anyone with stops beneath this low are getting stopped out. Smart money is buying from those sellers at a lower price. We get a shift in market structure to the upside when price takes out this short-term high right here. That is our market structure shift. And what else do we have? We have this fair value gap in here. Since it has the fair value gap after taking out liquidity, these consecutive down close candles act as a high probability order block. It is absolutely not just the last down close candle before that large up move with displacement. If you're waiting on that, you're missing this move. We have the consecutive down close candles. I'm going to mark out either the opening price or I can mark out the upper wick. Technically, the entire down close candle or consecutive down close candles is an order block. So this whole shaded area right here is a bullish order block. I'm just going to draw out these sensitive points. I don't want my chart to look all clunky. That's what ICT does as well. I'm going to mark out the upper wick on here. You could also mark out the opening price of the consecutive down close candles. Price returns into that upper wick, retest it as real support, and then we continue to spool higher. And I did call out in the Discord that I'm thinking price is going to take out this high. So we did create these relative equal highs. I do cover a lot of day trade setups in my Discord. If you guys are interested, the first link will be down below. And we did return to this high probability order block. Remember, we're trading with the order flow of the higher time frame, and our bias is for price to continue higher. So retest these consecutive down close candles as real support right here, because we have that fair value gap and it's taken sell stops. This is high probability. Then we start to spool higher. it takes out these relative equal highs up here. So that's going to be it for ICT order blocks. Now I do know more about order blocks, and I'm lucky enough to have come across some information that tells me which side of the market's going to get targeted. And the reason I bring this stuff up is not to brag that I have the secret sauce or whatever. I'm just trying to get in contact with ICT because I believe I have one of those concepts, or I'm aware of one of those concepts that give an unfair advantage, and I want to reach out to him so I can get permission to talk about it, because I know he's not permitted to talk about certain things, and I respect him a lot. So I'm kind of waiting for permission, but there is a little bit more to order blocks that not everyone's aware of. But yeah, if you guys could just tag ICT in the comment section down below, would greatly appreciate it. Let's move on to SMT divergence, and we're just going to be doing a little quick segment of SMT divergence in this video. What is SMT divergence? Well, when we do have correlated assets, meaning the S&P 500 and the NASDAQ, they typically move in tandem with each other, meaning they move together. If NASDAQ starts going higher, ES also goes higher, right? When we get a crack in correlation between correlated assets, it shows an SMT divergence. So to elaborate on that, we have a lower low on ES right here. So this is Wednesday, April 26th, and this low over here is Thursday, May 4th, right? If we take a look over here, ES creates a lower low from that date to that date. If we take a look at the same date over here, Wednesday, April 26th to May 4th, right? We create a higher low there. So now we have a crack in correlation between correlated assets. What does this mean? Well, it means that between the NASDAQ and the S&P, it is under real accumulation by smart money. So the fact that NQ is failing to take out this lower low, it shows that it's under accumulation and it's not willing to take out these lows because smart money's buying in here. So when this happens, typically the one that is creating the failure swing is going to be the one with strength to the upside. If we zoom out on this 4-hour time frame, everyone obviously knows that or at least if you keep up with these markets, that the NASDAQ was the leader to the upside. It was seeing much higher price action much quicker. And the reason is because smart money was buying this one first over here. The algorithm is going to make this one have more strength to the upside. And that is exactly what we see right here. Now, because we have SMT divergence, it doesn't just immediately mean we need to buy, right? There needs to be a bias and a narrative behind that idea. Since I already was expecting higher prices, and on June 1st, I was looking for 43.27.5. That was kind of my draw on liquidity for future price action. Because I was looking for that high already, seeing this SMT divergence was confirmation that, okay, I'm on side, right? Smart money's accumulating. We're seeing real accumulation right now. And the SMT divergence now sets the stage for the run higher. And then we start to continue to explore the upside. This is bullish SMT divergence. If you want to look at it from the opposite perspective, let's just do something like this, where ES makes a higher high, and then the NASDAQ makes a lower high. If this were to happen, it would mean that NQ is more likely to have strength to the downside, and it's likely to see lower prices faster because this one is under real accumulation by smart money. So because it's failing to take out this previous high, it's showing unwillingness to take out that high because it's under real accumulation. Whereas this one is still doing a stop run on the highs. This is SMT divergence. You can't look at it alone. You already need a bias as to why, and a narrative as to why price should already go in that direction. We had that here. So because we had that, the SMT divergence is just confirmation of that previous analysis. Now, I hope this video was helpful, and I hope you guys enjoyed. And if you want to see more ICT content like this, I don't mind doing these videos. I'll try and make them a little shorter, but I just really needed to clear the air and go over what is a high probability order block, because too many people have it twisted, and I don't want people to get a false perspective of what an order block is, because it's important that these factors are kind of factored into your analysis. If you're just looking at the last up close candle before a down move, or the last down close candle before an up move, it's not always going to work. So I'll talk to you guys later. I hope you have a good one.